This brand wanted to hit $60 million a year, and on paper they had everything they needed to do it. They had cash piling up so fast that their biggest worry was their end of year tax bill. They had amazing lifetime value, great retention, a quick payback period. But when I dug into their numbers, I realized they couldn't answer one of the most basic questions in e-commerce. How much money are you making on the customers that you're acquiring? Nobody on the team seemed to know. And because nobody knew, they were doing the one thing that a brand this big with this much potential shouldn't be doing, going very slowly. See, when you don't trust your numbers or have visibility into the data, you really only have two options. You go very slowly so that you can play it safe with a huge margin of error so that you don't take risk that you're not aware of, or you YOLO it, scale as hard as you can and hope for the best. But to be able to walk the optimal path to scale as fast as you can sustainably without taking unnecessary risk, you need to have good data. They didn't have it, so they moved incredibly slowly and that cash just sat there. Now I realized how bad things were when I was running a growth cash dash. This is like a financial x-ray of a brand's real numbers, their e-com KPIs, and kind of what their strategy looks like. So in this video, I'm going to walk you through that x-ray in the order that things happened. What I looked at first, the moment I realized that the books couldn't be trusted, and the handful of numbers that you can look at in your own business to know if you're scaling on data or on vibes. Let's get into it. So this is a women's wellness brand. They're doing over $20 million a year, great retention, have good subscriptions. They sell primarily on their own website as well as Amazon, and their customers love the product. This brand has a ton of potential. They reached out because they wanted help with their targets and because they wanted to build out a map to be able to grow to $60 million. They brought in a new head of growth and told him to be profitable, and he did exactly what you'd expect. He pulled spend back. New customer acquisition dropped and growth slowed. So now they're wondering, are we scaling as efficiently as we can? What should our targets actually be to hit the goals that we have? And then they asked me the question that tells you everything that you probably need to know about this business. They're like, we're heading into the end of the year, and if we don't spend all this cash, we're gonna have to pay a lot in taxes. So should we just spend it? Should we buy a billboard in Times Square? Should we double our ad spend? Now think about that for a second. Their problem is not having enough money to scale. Their problem was that money was piling up faster than they knew how to spend it. So I pull all their data and start building out all the KPIs, and high level, things are very healthy. Most months, the profits from their returning customers cover all of their fixed expenses. Even with all their aggressive acquisition, they're still very profitable, and their cash just keeps piling up. They're sitting on almost $7 million of cash. And back of napkin math made it seem like they'd break even on a new acquisition in about 3 months. Given their retention, their profitability, and their cash flow, that was very conservative. And so I told them, based on all these high level numbers, everything looks extremely healthy in the business. But the deeper I went, the more I realized it was kind of hard to tell them exactly what they should do next. The first thing that felt off was something that I see a lot of brands do that I think is a massive weakness in e-commerce reporting, but it's something that a lot of regular accountants don't know about. It's that they didn't have their profitability broken up on a per channel basis. The Shopify and the Amazon profitability and cost of goods sold were all blended together in one line. So a basic question like, is Amazon more profitable for you than the website? Unanswerable. And then their discounts, also not broken up from their gross revenue. So when they have profitability swings from month to month, it's hard to know how much of that is because of new discounts or offers or something else. And because we can't see gross revenue clearly, we also can't calculate certain ratios like their product cost ratio. But there was something even worse than that, which was their cost of goods sold. One month they'll have $600,000 of COGS and the next month, zero. Then the month after that, another big number. What that obviously means is that they were booking their COGS on a cash basis. Doing cash basis accounting is suboptimal for any e-commerce brand, let alone one doing $30 million a year. Because of that, we can't actually see how profitable they are from month to month. One month your sales have zero inventory costs, so your margins skyrocket, and the next month you're buying 3 months worth of inventory, so your margins plummet. So now we don't have confidence in what their gross margin actually is. And your gross margin is one of the core numbers upon which all of your targets are built. It determines what your pricing should be, what your CAC or ROAS targets are. When your visibility is that bad, it's like shooting a dart at a dartboard, but both your eyes are closed. You could get lucky and hit the target, but you're taking a lot of risk. On top of that, I asked them about fulfillment. Turns out their manufacturer also fulfills for them, but the manufacturer uses one system to track fulfillment and they're using another system, and neither of them reports properly. So at this point, I know one thing for sure. Their data is so terrible that their targets are set completely based on vibes, but they're sitting on so much cash in the bank that their vibes-based target was just playing it super safe. But on the plus side, that means that if they actually fix their targets, they have so much potential to scale because people love the product. So as we're going through the call, I know that there's obviously a lot of flaws in the data, and I'm explaining this to them, but then in the middle of the call, someone mentions TikTok Shop. And I'm like, wait, hold on, you're doing TikTok Shop? Because I just gone through all their financials and I didn't see anything about TikTok Shop anywhere. So they're putting real money and investing into a channel that they're hoping is able to drive a lot of growth, and there's no visibility around it. And so that became the whole theme of the call. Every time we tried to figure out a target, it would just slip away. The thing is, the more channels that you have, the more important it is that your granularity in your books are actually done at a channel level. TikTok Shop, for example, is oftentimes going to be run at break even or unprofitably. That's because a good 70-ish% of the value that the TikTok Shop ad engine is able to drive is actually captured off of TikTok on Amazon. So in a lot of cases, to be able to understand how much value you're actually capturing on TikTok Shop, or if you're just wasting money, you need to be able to look at the profitability, the revenue growth, and the branded search growth on Amazon separately. But if everything's just blended together and you spin up a new channel, you don't know how much you're actually losing on that channel, and you can't really see how much value it's driving on other channels. A new channel might be tanking performance, but another channel is actually doing quite well, and because it offsets one another, everything just looks fine. And so the problem isn't that they had bad performance somewhere, is that we didn't know where the good performance was so that we could double down. We just knew that things were doing pretty well overall. Now, somewhere in the middle of this, the founder asked me how I built this analysis that I was walking them through. And I told them, you sent me access like about 30 minutes before we had this call scheduled, so I just whipped it together as fast as I could. We're actually looking at it for the first time together on the call. But what's interesting about that is if an outsider can take 30 minutes to crank some numbers together and then jump onto a call and start identifying all the flaws in the data, how hard is it to run a business like that yourself? Now, in fairness, they were clearly running a fantastic business, very successful, made a lot of progress. It's just that they could have been twice as big if they just had better visibility into those numbers. But number after number, KPI after KPI, there was just more questions and uncertainty around what was going on there. So near the end, they just asked me straight up, like, what do you think of our setup? I told them what I would tell a friend. There is an extremely good way to be able to do your finances, and then there's basic, and frankly, you are respectfully below basic. For a company your size, this is nowhere near enough visibility for you to be able to take advantage of the potential that you have. And look, to be clear, nobody on that team was incompetent. They were clearly very good at marketing, acquiring customers, and building a brand. They had the kind of performance and metrics that other brands would kill for. It's that they missed out on the other 30 million they also would have had their data been better. So let's come back to their actual question. We have too much cash. Where should we spend it? And here's the answer I gave them, and this is kind of like the core of the video. When your data is all lost in a fog, there's only two ways to run a business. Option one is that you play it super safe and you sit on a giant pile of cash to keep you feeling comfortable that you're not taking risk. Your returning customer cohorts are stacking over and over and over because you have such good retention. But because you don't know on a per customer basis how much you can spend to acquire one, you're trying your best to acquire them profitably. Or option two is you scale aggressively and maybe you can hit that 60 million target that you have. But if your data is still bad, you're just taking a risk. Maybe you're going to burn the business out. But with the right data, there is an optimal path for you to take. You know what the actual perfect ad spend and CAC targets are to maximize the amount of lifetime profit you can bring in from a customer. You have a forecast to be able to see exactly how that affects your cash flow. And then you have good visibility into the data financially to know where are you spending on things that aren't driving value and how can you actually allow yourself to spend more on ads to be able to scale faster as you go. They didn't have the data, so they didn't really ask the question. They just defaulted to option one. They didn't choose to grow slowly. They just didn't realize that they could be more aggressive. And cash piling up in the bank just felt like success to them, which in some cases it can be if that is your goal. In their case, it wasn't. They actually wanted to scale aggressively. They wanted to double in size because they wanted to exit someday, but they weren't moving towards that stated goal because they were just piling up cash. And not only did this strategy come with the opportunity cost of them not growing as fast as they could, but it also meant that they had a ton of profit left over that they had to pay a huge tax bill on. Their bad data was probably costing them a lot in money being spent on things that weren't valuable or profitable, but the much bigger cost was taking money and just giving it to the government in the form of taxes and then delaying your ability to hit that 60 million and then 90 million number. It's kind of like if you had $20,000 of spare cash sitting around. You could put that into a retirement account so it starts compounding, or you could just let it sit in the bank and do nothing. So here's the plan that I laid out for them, and in this specific order on purpose. First, you need to fix the books. You need channel level tracking, real COGS that are based on accrual methodology, and you need granularity that breaks out certain numbers for different KPIs, like your discounts being separated out. So mostly things that are just boring but foundational. The second is that now that we have actual data we can use, we start building out our model. That means knowing our actual lifetime profitability on a cohort basis, which then gives us a proper target as to how much we can spend to acquire customers. That also tells us how hard we can go and how much cash we can burn down without it being unprofitable. And once we have good visibility into the AOV, the retention, the lifetime profitability, their acquisition cost, now we can do a lot more testing around bundles and offers and landing pages to see how we can expand that. So you start with clean data, then you set the right targets, and then you can be aggressive and start pushing the envelope. And then the tax question also answers itself. You don't buy some giant billboard just to be able to get cash out the door, even if it's not incremental. You find your optimal targets for ad spend, and then you invest as much as you can into creative, into the marketing machine so that you can spend more optimally. And that's the whole lesson of this story. The gap between the $30 million version of this brand and the $60 million version of this brand wasn't marketing. Their marketing was exceptional. It's that they couldn't push on the gas because they had no idea what was happening in front of them. Remember their question at the top, how do we spend all this cash so we don't have to pay taxes? That was never the real question. The real question was, what do we do next? And the takeaway isn't that this team didn't know what they were doing. Like I said, they were very good at what they were doing. If anything, they were arguably too good, which is why they were so lackadaisical about the finance side, because they never felt that it was a constraint. But a brand that's flying high, they don't really think about it because from their perspective, everything is going great. The problem is that the opportunity cost of being twice the size is oftentimes invisible. There is an optimal strategy to be able to execute on to run your brand. And every brand that's just ignoring it and scaling on vibes is just doing themselves a disservice, either leaving a ton of money on the table or throwing a lot of money in the trash. And that's why we run the Growth Cash Dash. We take your historical data, crunch over 30 e-com finance KPIs, we tell you where your data might be lacking integrity, and then how to interpret that data to make the right strategic decisions for your brand. If you want to see if you can get a Cash Dash for your brand, the link is in the description. But I hope you enjoyed this edition of our Cash Dash stories. Tune in for the next one. Until then, take care.